All right, thanks everyone. Welcome back to another webinar. As you know, the three of us, Donna, a financial advisor, Yuri, you, a CPA, and myself, as an estate planning attorney. We talk about financial planning and estate planning, tax matters that will provide you with education and knowledge. This month, we are spotlighting each of our members. If you've missed the webinars from last time, we focused on taxes for 2021. Last month, we did estate planning basics. And today, Donna Lee will be presenting on financial planning mistakes. If you show the next slide, Donna, then just a quick little disclaimer that, of course, you know that we're recording this webinar. You probably clicked on a consent, and just a quick little disclaimer that it's not financial, legal, or tax advice. There's no attorney-client privilege. Of course, if you need to take a screenshot, it's okay for just personal reference, but if you need to do anything further with that, let us know before you. All of our webinars are recorded, so after this, you'll be able to get a link on YouTube and review this again. Next slide. Oh, and just to say, if you have any questions, put it in the chat box below. All right, so let's get started. Yuri, do you, I know that you have a lot of people asking you these questions, as well as Donna. What are some financial planning mistakes that you see, Donna? Do you want to just get started right into it?
Yeah, absolutely. First of all, let me say it's good to be back. I'm sorry I missed you guys for the last 2 months. We had our second daughter back in February, and we're all dealing with lack of sleep these days. So it's good to be back. But let me just jump right into it. After being in the financial planning industry for almost 20 years now, this issue of risk tolerance is one I see time again and again. And I think it's because it's been beaten in our heads with society that we always want to match risk tolerance to our age, right? It's been beaten in our heads that the younger you are, the more aggressive you can be, and the older you are, the more conservative you need to be. But that is not always necessarily true. So there are some considerations that maybe you want to pause and kind of think about this before you decide on risk tolerance. Here are 2 common ones that come up. If you plan to change jobs soon and you have a 401k at work, you may want to be more conservative in that 401k regardless of age, just because one of the options is you can take that 401k and roll it out into your own IRA, and you want to make sure that major fluctuations aren't going to change that account value. The other one to consider is if you have assets that are intended for the next generation. Again, regardless of age, if this is an account that you don't plan on using, you don't need to tap into, and it's really for your children or your beneficiaries, then we can afford to be a little bit more conservative with those accounts, with that account. Not funding a trust. Now, here's a common issue with a lot of clients, especially if you live in California. If you attended our webinar last month, so Sophia talked extensively about the basics of estate planning. If you missed it, you can watch the replay from our website. But there's essentially 2 parts to setting up a trust. The first part is actually the creation of the trust. This is where you would meet with an estate planning attorney, discuss your wishes and who you want to list as your power of attorney, your trustee, the executor, the guardianship if you have minor children. This is everything that you do with an attorney to set up the trust. At the end of this, you get a big binder and everything is done in terms of the trust. But that's only halfway done. Part 2 is you need to make sure you put assets into the trust. So these are assets that you want to make sure that follows the rules of the trust that you just created. So 2 common ones that people sometimes forget about is real estate and any non-retirement accounts. Sometimes I get asked, how do you know if you have funded your trust? The easiest way to figure that out is to basically take a look at a statement. For any non-retirement account, take a look at that quarterly statement. It should, on the top where it is mailed to, instead of your name or you and a spouse's name, it should say the name of the trust. If it's a real estate asset, then you want to take a look at that property tax statement. And again, it should have the name of the trust listed right on there. This actually happened to a client's father. I wasn't really involved into this process until the dad passed away. But when meeting with the clients, they were pretty confident that they got their trust done. They had the big binder and everything, but it turns out that the trust was created, but it was sitting empty. So make sure you double check that you did fund your trust.
Absolutely right.
I'm sure Sophia would definitely agree. Not knowing the priority to withdraw accounts. So this comes up often. Most of our clients, they are really good savers. And so not having enough money is not really an issue. They have the accounts all saved up. They have all the various accounts set up. But when it comes to actually taking the money out, they're not sure which account should they be withdrawing from. So obviously every situation is unique, but here are some considerations. Avoid premature or non-qualified withdrawals. So this typically pertains to retirement accounts, education accounts, or certain trust accounts. All else equal, between pre-tax accounts and post-tax accounts, one thing that you want to consider is whether you're planning on having a higher taxable income later on, or if it's going to decrease going forward. But if everything is the same, you prefer to take from the pre-tax account first so you can allow that post-tax account to continue to grow tax-free. For non-retirement accounts, there can be multiple investment strategies that you use. And each investment strategy can have different tax implications. So all else equal, you want to take from the account that has the least tax implication. If you're withdrawing from any type of an annuity, a lot of annuities these days, they have income bases, but these income bases are calculated only on anniversary dates. So be aware of that if you are right before an anniversary date. If you have any life insurance policies that they have cash value in and you're planning on taking withdrawals from it, make sure to take a look at it, double check, and you want to make sure you don't want to accidentally cancel the policy. We'll be talking about this a little bit later. And then just be aware of any one-off rules. Last year, for example, there was the CARES Act, and it made some changes with retirement plan, with withdrawals from retirement accounts. So that maybe it's not so bad to withdraw from a 401k if you're under 59 and a half.
Yeah, I'll just jump in and say real quick, whenever there are those like one-off 1 year exceptions, you just want to make sure you really review the rules and understand, you know, when those apply. I know I had some clients who knew that like in 2020, you could take retirement distributions for COVID related reasons and not have to pay the penalty. But some people thought that that applied to 2021 as well. Mm-hmm. And so they did take distributions in 2021, which that exception doesn't apply to. Or, you know, there's rules, you know, whenever they do those exceptions, you just want to make sure you read the fine print.
Yeah, and if I remember correctly, that deadline was December 30th last year, which was weird because it wasn't December 31st, like it usually is the last tax day of the year.
Yeah, that makes no sense and doesn't surprise me at all.
Yeah, it's strange. Required minimum distribution mistakes. Now, these can be very expensive mistakes. RMDs are how the IRS collects tax on pre-tax accounts. It's a 50% penalty if you take it too late or you take it from the wrong accounts. They must be taken by the end of the calendar year, so 12/31, and it must be taken from applicable accounts. So that implies that not all accounts apply, only pre-tax accounts apply. So if it's a 401k or an IRA, those are pre-tax accounts. Prior to 2020, you must take RMD starting at 70 and a half years old. I don't know why it's 70 and a half. It's one of those weird things that the IRS has. But starting in 2020, they increased the age. So it's not 70 and a half anymore. Now you have to start taking RMD starting at 72 years old. If you have any beneficiary IRAs or inherited IRAs, that means you were a beneficiary of someone who passed away and you inherited that IRA. So if that death occurred prior to 2020, you have the option to stretch the withdrawals by taking the RMD only. that only apply for deaths that happened prior to 2020. That no longer applies going forward.
Donna, 50%, that seems very steep. What is that 50% percent of what?
Of the actual RMD. So if your RMD is, let's say $1,000 and you did not take it, the penalty is 50% of that RMD. Now, I have heard that while the penalty is very steep, I have heard that it's not difficult to petition the IRS if there's like any type of mitigating circumstances. They're pretty lenient from what I've heard on giving you a freebie. So if that happens to you and you receive a notice, make sure you talk to your CPA and maybe you can request that the IRS give you some type of a grace period.
So who's keeping track of that then?
The RMDs, the investment companies are. The RMDs are calculated by the investment companies. Typically, it's based on the 1231 account value of the account divided by some type of a factor based on your age. So the investment companies will send you a letter and it'll tell you this account has this RMD that you have to take out, which reminds me, it's important to note that you actually don't have to take that RMD from that account. So for example, if you have two IRA accounts and one RMD is for $1,000 and the other one is the RMD is for $2,000, you don't actually have to take 1,000 from here and 2,000 from here. You just have to take a total of 3,000 from this one or split it up however you want. The IRS doesn't care. It's just the total amount is really what matters. So make sure you talk to your advisor and your CPA and do some tax planning. Take control of those taxes before these withdrawals become mandatory.
So if I need to take RMD starting at 72, like when do I need to start talking to you?
The earlier, the better. I have done a lot of tax planning for clients even 10 years prior. There are a handful of clients that they're very blessed not to have to need these IRA accounts for retirement purposes. So their intention is to just save this for their children, in which case they'd rather pay the taxes on them now rather than later. So over 10 years, we're able to convert the account slowly over to a Roth IRA, and then they never even have to address RMDs. So the situation is different for everyone, but the earlier that you're aware of these, the better it is. Refinancing. So we're in a low interest rate environment these days, and it seems like every few days there's news that we should refinance again because rates went down. But aside from purely looking at the monthly payment, consider the total cost of your home. So here's an example. Let's say you bought a home 10 years ago. You had an $800,000 loan. It was a 3.5% fixed rate for 30 years. Your monthly payment is $35.92 a month. Okay. 10 years later, let's say today, now you only owe $617,000 and rates have dropped. It's now 3% fixed for 30 years. And if you refinance, your monthly mortgage is only $2,600 a month. Should you refinance? Well, this is just another way to consider this. So you've spent $35.92 a month for 120 months, right? 10 years, which is 120 months. So you've already put $431,000 into this home. Now, if you refinance to that second loan, you're actually, and let's say you keep this loan for the entire duration, you would put in $937,000. So if we add these two together, you end up with $1.3 million out of pocket. Compare that to your initial loan of only 1.29 out of pocket. So had you not refinanced, you would have paid less over 30 years. So in general, the longer that you've been in a loan, the bigger that rate difference needs to be to make it worth your while, because you're essentially starting over with a 30-year loan, unless you're looking at shorter term loans, which are available as well. Buying real estate in retirement accounts. Many people don't even know that you can buy real estate in a retirement account. It's called a self-directed IRA, and you can buy all sorts of things in there, like real estate, business interests, promissory notes, even tax liens. But just because you can doesn't mean you should. And this can be a real nightmare. I have a client who purchased raw land in their IRA account many years ago. All is fine until RMDs start. Now this asset will need to be appraised annually to determine the RMD amount. Now, if this asset is not liquid and it's not income generating, like raw land, you'll have to withdraw the RMD from another IRA account, assuming there is another IRA account. Now, thankfully, my clients do have another IRA account, so they can just withdraw their RMDs from that account first. But eventually, they're going to have to start taking RMDs on this account, raw land. But how do you do that? Just sell a chunk of dirt every year? How do you do that? So this is why now they're looking to dispose of it before they run into this issue. It's not easy to sell undeveloped land. Then there's this hesitation that after 15 years or so of owning this plot of dirt, there is finally some potential for growth. There is a recent development nearby, so they're really looking for the land price to shoot up. So, but they don't want to deal with this RMD issue. So they're looking to sell that land to themselves, essentially removing it from the retirement account and all the RMD requirements to just themselves. But the problem is IRS has a strict self-dealing rule that will prohibit this transaction. So for now, we're just hoping that the land will appreciate enough for them to sell it, all before they need to take RMDs on this account. So long story short, it's best to stick with assets that are easily valued in your retirement accounts. If you like some type of illiquid asset or real estate and such, it's best to purchase that outside of your retirement accounts.
And there are times that self-directed IRAs, like certain situations, they will actually need to file tax returns. I believe it's when if you have a property in the self-directed IRA that also has a loan or a mortgage on it. And so there can be tax consequences of owning real estate in these IRAs.
It just sounds hairy. These are complex situations that can get very complex quickly.
Mm-hmm.
Then why would someone use a self-directed IRA than regular, just like a company, regular IRA?
As like regular securities, stocks, bonds, mutual funds? Because the potential for real estate sometimes, it's nice to have, for it to be tax deferred for the most part. And you can get a tax, it's following the rules of the IRA account. So you can get it, put pre-tax dollars in there. You don't have to worry about taxes throughout the years where it's growing. That's why. In the case of my client, raw land is usually cheap to buy, and when it becomes developed, the price shoots up significantly. Maybe like 50,000 to purchase, and by the time it's a usable plot of land, it could be in the millions. So it has high appreciation value. Not being up to date with beneficiaries or using the default beneficiary. Now, this is one of the easiest things to do. And yet, if it's not done, it causes the biggest headaches. And this one, we definitely see time and time again, okay? So let's just review how beneficiaries work. You have an owner. If the owner passes away, the money goes first to the primary beneficiary. If the primary beneficiary has passed away already, or maybe the primary beneficiary doesn't want this asset and they disclaim it, then it goes to the contingent beneficiary, okay? In community property states like California, if the owner is married, the spouse must be 100% their primary beneficiary. Otherwise, they can waive their right, but they have to waive their right. Okay. So a couple of considerations to make sure that you're up to date with your beneficiaries. Anytime you have a beneficiary that passes away, make sure you update your accounts. Make sure you update the beneficiary and name somebody else. Okay. Minors, if they receive an inheritance, there must be a guardian that is appointed on behalf of them. So as these minors become of age and they become adults, consider naming them outright, as opposed to naming a custodian for them or naming the living trust as a beneficiary. And then occasionally there's changes in tax laws and trust laws. Most recently, there is a Secure Act that was passed. And anytime these occur, you want to touch bases with your estate planning attorney to make sure that it still makes sense, that your trust is still okay to be a beneficiary on certain accounts. There are default beneficiaries if you don't list beneficiaries on your accounts. But just because there are default beneficiaries, it's not necessarily a good option to use. So our office is very particular. We will not open a retirement account unless there is a beneficiary designated on there. Recently, I had a client ask me why bother even filling out a beneficiary form, because her employer tells her that there's no need to, because on the 401ks, for example, it'll just go to default beneficiaries. That is true. It does seem redundant. However, literally the next day, another client of mine called to tell me that her mom passed away without naming any beneficiaries on her 401k. So in this case, default beneficiaries do apply. So by default, the husband is now the sole beneficiary of her 401k, except that was never the plan. He was going to take the life insurance proceeds and their 2 adult children were going to split the 401k. Well, to do that, now that he is the beneficiary on the account, to do that, he would have to withdraw the entire 401k balance. In this case, it was like about $500,000, pay income tax on it, which is a lot, maybe 45, 50% between federal and state, and then take the proceeds and split it in half for the 2 kids. So after tax, each child would receive significantly less than what they were expecting. Had the mom just listed her 2 adult children, then we would be able to split that 401k directly into half, with each beneficiary having complete control over their portion. They can independently withdraw and pay taxes as needed. So in this case, we're still currently petitioning the plan sponsor to see if the dad can disclaim the account to the children. We're still waiting on their decision. So in the meantime, name those beneficiaries on your accounts.
If someone is single and then they get married, I guess they should probably update their beneficiaries. Like, will it automatically go to the spouse, or if they have someone else named as a primary, will it go to the primary, even though they were unmarried when they made that election?
It's based on when they passed away. So if they passed away and they were married at that time, then it would go to the spouse, regardless of who they named. Now, a lot of times investment companies don't know this, right? Like if someone passed away and there's a death certificate and there's a beneficiary, they'll just issue the inheritance. Basically, they'll just they'll issue it. But the problem is, if the person was married at the time of death, the spouse can come back and claim and say, no, we were married. She just never updated the beneficiary. That money is mine. And in most cases, they will receive the account.
I would also just jump in and add that if you do have 401k before you are married, it may be at least a portion of it considered separate property. So you may want to talk with a family law attorney about either a prenup, a premarital agreement, or a postmarital agreement, just to kind of define like what happens with IRAs, 401ks, anything like that before marriage, and then what happens after. Does it stay that way? Like what's going to happen?
A lot of times, especially in a 401k plan, you're subject to whatever the plan sponsors say. And a lot of times they don't, unless there was a case that was similar to yours prior, there's no precedence. So it's really up to whatever they want to say at that time. So it's best to name your beneficiaries, whoever it is you want it to be, and consult with an attorney if you're getting married.
Yeah, I think that's a good reminder, because it's one of those things, like, especially when you're starting a new job and you have like a mountain of paperwork to fill out and you're like, I don't know what I'm supposed to put, I'll just deal with it later. And then you just forget.
Yeah, absolutely. All right. Confusing Roth 401ks with after-tax 401ks. Now this one is confusing because a lot of times Roth is synonymous with after-tax, because you're funding Roths with after-tax dollars. But in a 401k, they are different. So most people understand, they've heard of this 19,500 as the limit. That's the most you can put into a 401k every year. It's true, but that's only the most that you can put in as an employee from your salary deferral that you can put in. Employees, if you are over the age of 50, you can also do a catch-up contribution. Employers can also put money in the account as well through matching, or possibly like a profit sharing contribution. And then anything else above that, up until 58,000 for 2021, the employee, you can actually put more money into the 401k plan. It's called an after-tax contribution. So the differences between an after-tax 401k and a Roth 401k. So a Roth 401k is part of that 19,500 that you put in as a salary deferral. As the employee, you get the option. You can choose whether you want that money to go in pre-tax or post-tax. If you put it in pre-tax, it's called a traditional 401k. If you leave the employer, leave the company, you can take that entire account and roll it over to an IRA. If you put the money in post-tax, it's called a Roth 401k. If you leave the employer, you can take that entire account, including the earnings, and roll that into a Roth IRA. And that is where they're different. If you look here, Roth 401k and after-tax 401k, the contributions are both post-tax, the growth is both tax deferred, but the difference is in a Roth 401k, the distributions are all tax-free. When you quit your job and you do a rollover, it goes completely into a Roth IRA. But if you had money in this after-tax bucket, the earnings are taxable. So if you quit your job and you roll this account out, the basis, which is the amount that you actually put in, that part will get rolled over to a Roth IRA, but any earnings will be rolled over to an IRA. This was interesting because one time I had a client who thought she was maxing out her Roth 401k, and it turns out she was making after-tax contributions all year long. So don't assume that the first dollars going into the plan is necessarily salary deferral.
So I think what you're saying is that the 401k Roth 401k is more preferable than the after-tax one, but then how do you know which one you're contributing to?
Good question. So take a look at those quarterly statements that you have, that you receive, or maybe the 401k has a website you can log into, because they will keep track of the various buckets of money. They'll tell you how much you put in for your salary deferral, how much you've put in for after-tax. So that's the only way you would keep track.
Are you saying to fill up the Roth 401k first and then anything else go into the after-tax one, or can you do it at the same time, or what's your recommendation?
I would fill up the Roth 401k first, just because if you're going to put money into this post-tax, the Roth 401k is more advantageous because when that account grows, all of that is tax-free. Whereas when you put money into this after-tax account, only the basis is tax-free. The earnings are still going to be taxable. So between the two, I would definitely do the Roth 401k first.
Is there a reason why you would do the after-tax 401k as opposed to just putting your after-tax money in like a Roth IRA or like another type of IRA?
So if you are short for retirement, if you want to catch up a little bit, or if you just have a lot of income and you don't need this, that's why people are considering contributing into this after-tax bucket. You asked, would they just put money into a Roth IRA? They can. However, Roth IRAs usually have income limits. So if you make too much money, then you can't actually use a Roth IRA. But remember, any contribution that you make in this 401k, whether it's salary deferral or after tax, it's all considered retirement. So you won't be able to touch it until 59 and a half anyway. So take a look at your budget and see, do you really want to save up this large amount into something that you can't touch for a certain number of years? This one is a big one for employees of publicly traded companies with highly appreciated stock, since this has the potential to save a ton in taxes. So we had a client who retired after many years at Boeing. Over the years, Boeing had issued him company stock in his 401k plan. When he rolled out his 401k plan, we were able to pull the Boeing stock out of the 401k plan and put it into a non-retirement account. Now remember, if this Boeing stock was in the 401k plan and we rolled the entire account to an IRA, any withdrawals out of that IRA would be taxed at ordinary income rates. But because we pulled out the Boeing shares, when we do that, we do have to pay income on the basis immediately, and it's at ordinary income rates. However, now that it's in a non-retirement account, all the gains are not taxed at income rates anymore. It's taxed at long-term capital gains rates, which would be significantly lower. Okay, so in the highly appreciated stocks, situations, it makes a lot of sense to do that because the basis is low compared to the account value. And then as a side note, if this client or if someone doesn't actually need this money, they never take money out of here, they will never be taxed at long-term capital gains rates. Let's say he passes away and gives it to his children, there's a step up in cost basis. These children can turn around, sell the stock immediately and never have to pay any taxes. So this is huge when you have highly appreciated stock in your 401k plan. Not keeping track of IRAs or Roth IRA basis. Basis means it's the amount that has already been taxed. So for pre-tax accounts, the basis is 0. For after-tax accounts, the basis is whatever amount you put in. Most people understand why it's important to keep track of basis for IRAs because you can have pre-tax IRAs and post-tax IRAs. But it's also important to keep track for Roth IRAs too. Generally, the main reason is upon withdrawal. So if you withdraw from a Roth IRA after holding it for 5 years, you can actually withdraw this, the basis, the amount that you put in, penalty-free, even if you're under 59.5. But you can only do this if you keep track of your basis. So it's a good idea to keep track of how much you've actually contributed. Keep your CPA aware of this, or I believe like tax planning softwares can keep track of it as well. But it is important when it comes to taking money out of retirement accounts. Backdoor Roth pitfalls. Backdoor Roths can be used if you don't qualify to contribute directly into a Roth based on your income. The idea is to contribute to a non-deductible IRA and then convert it to a Roth. But this strategy is best to use only if you have no other pre-tax retirement accounts. Otherwise, the IRS will aggregate all of your retirement, all of your IRAs as one giant IRA, and any conversions that you do, they'll use, it'll be done pro rata. So for example, you have a $6,000 pre-tax IRA and you just funded a $6,000 non-deductible IRA. When you convert this non-deductible IRA, the IRS will see it as 50% taxable and 50% not, when your intention was for it to be all not taxable. Does that make sense? So this can be easily avoided by checking to make sure that you have no other pre-tax IRA accounts. Another common issue is forgetting to file a Form 8606. So this form lets the IRS know that you've made non-deductible IRA contributions. So when you convert them, only the gains are taxed and not the entire amount. So we don't want to utilize this tax strategy, do a bunch of paperwork, and then end up not benefiting from it at all. Okay.
When it comes to backdoor Roths, Donna, is it better to, like, should there be a lag in between when the non-deductible contribution is made and then when it is converted to a Roth, or can you do it immediately?
Good question. So if we had a crystal ball and we know how the market is going to do, then we'll know, right? But because we don't, ideally it's best to do it right after the money goes in. You put $6,000 in as a lump sum, and immediately once that check clears, you convert it so that there is no gain or there's no loss either. So that's, from a tax standpoint, that'll probably be the cleanest way to do it.
Donna, would you do a backdoor Roth if you haven't maxed out your Roth 401k?
Good question. I would probably do the Roth 401k first. It's a lot easier to do, a lot less paperwork, same intended consequences. So I would definitely max out that Roth 401k first. One thing to note though is that not every 401k plan allows for a Roth 401k plan, Roth 401k. So check with your employer to make sure that's an option first. All right, permanent insurance. These insurance policies can have a lot of moving parts. So it's important to keep an eye on them to make sure that they don't accidentally lapse. So what makes a permanent policy permanent is that cash value component. Over time, there can be significant cash accumulated in that account, and sometimes people start to take withdrawals against that cash value. So a few years ago, I had a client who came into the office wondering why he was receiving a 1099 on a life insurance policy. His father had recently passed away and they never even received a death benefit. Life insurance death benefits are tax-free, so this sounded a little strange. Turns out his father had a permanent life insurance for years. And then about 10 years ago, he started to withdraw lump sums from the cash value. Over the years, he depleted his cash value significantly. He took his last withdrawal, then the policy lapsed, and then coincidentally, he passed away 3 months later. Now, because his policy lapsed before he passed away, even though it was just 3 months, all withdrawals that exceeded what he put in come out taxed at income rates. And there's no death benefit since the policy lapsed. Had he passed away with his policy still in force, even if it was just $1 left in the cash value, all of the withdrawals that he took would just be netted against the death benefit, with the remainder passed to his beneficiaries tax-free. So that 3 months literally cost his family hundreds of thousands and a 1099. So this could be a big issue. So be careful if you have permanent insurance policies and you're planning on withdrawing from them. Business owners. One benefit of being a business owner, one huge benefit I would say, is that there are a lot of different retirement options available. It's a great way to save tax. It's a great way to retain employees and save for retirement all at the same time. It's a win-win-win. Your options can change though based on a lot of factors. So it's a good idea to review those options every year. Some plans might even allow you to save hundreds of thousands in tax. So it's definitely worth it to know your options. But what's worse than not taking advantage of a plan is using the wrong plan. Just last year, I had a client who was referred to us because of this very issue. He's an attorney and has been a solo practitioner for many years. He has hired a few people throughout the years, but they were all part-timers and kind of short-lived. During this time, he had a solo K that he max funded. Well, 3 years ago, his staff started staying on longer and they became eligible to participate in his retirement plan, but he didn't know that. And he didn't realize this until now. So now he's in the process of making it right with all of those employees from 3 years ago. So this can be expensive depending on how big that payroll is, because now he owes all of those eligible employees contributions from previous years.
I think that's just a great example of where, like, as your life gets more complicated, it is important to find people that are experienced and, you know, professionals that can kind of help you, because it's really tempting to just be like, oh, I can do the research and I can figure it out myself, not realizing that you could be making mistakes that are going to cost you.
Yeah, that's true. That's true. So this is, I think, a very important thing to be aware of. It's to talk to your CPA, your attorney, and your advisor. A lot of times you don't realize that what you do here can affect over here as well. These are just a few mistakes and issues that we've ran into in our almost 20 years of practice. It's good to learn from other people's experiences. So hopefully you've learned some of the things to be aware of. I know we covered it pretty quickly and some of it can be pretty technical, but feel free to ask us any follow-up questions. Feel free to email us.
Yeah, thanks, Donna, for all of that really great information. I don't think we have any questions. So, Sophia, did you have anything you wanted to add? Okay, well, thank you all for attending. We know your time is valuable and we try really hard to provide content that is both interesting and informative. Please join us for our next webinar. It's on May 21st, Friday at 12 o'clock. We're going to be discussing rental properties just from our different perspectives. You can find a link to the recordings of all of our prior webinars on the website where you signed up for this event. And the recording for this webinar should be up sometime next week. We'll be sending out a short survey in just a few minutes, so we appreciate your feedback and let us know if there's any topics that interest you that you'd like us to speak about. Thank you again and have a great weekend.
Thanks, everyone.
Thank you.